2024 is going to be an amazing year for the stock market. Now, the S&P 500 index has blasted past the 4,800 resistance mark pretty much straight away over the last week. And we've been hitting new highs over the last couple of days, and we are quickly approaching the 4,900 mark for the S&P 500. There's a couple of reasons why this could be one of the best years for the stock market. This could be attributed to the slowdown of inflation, the tightening of the rate hike cycle, and the projected increase in annual GDP increase. But there are two potential problems that could derail this entire situation. And I'm going to talk about all of that as well. So let's take a look at the chart for the S&P 500 index. So for over the past week, we had a real bull run for the S&P 500 index past the 4,800 mark, quickly approaching the 4,900 mark. Now, many people have basically said that, look, you don't really know exactly whether the stock market is going to go up or is it going to go down. I mean, it could go either way. And see, this is completely true because no one can exactly predict the future. What we could do here is look for opportunities. We are not trying to predict exactly when the market is going to go up or when exactly is it going to go down. We are looking for opportunities to add to our positions. Say, if I were just going to trade, there's no way I can be faster than a trading robot. Like, there is absolutely no chance. Robots can trade at like milliseconds, microseconds. You can't even click that fast. So if you want to beat a trading robot, that is absolutely impossible. But what you can do is to understand psychology. You understand that it is humans, after all, that are actually processing these trading robots. It is humans that are still putting money into the system. But what does that actually mean? It means that there are certain things that humans really care about. Humans really care about names. They care about terms like bull market, bear market. They care about things like recession. They care about things like all-time highs. So how can you use this to your benefit? So if you look at the chart here, we're reaching past the 4,800 mark. And 4,800 now acts as a resistance for the market. So you would think that if people start selling their positions now, you'll look at a pretty strong resistance at the 4,800 mark. Similarly, if the S&P 500 index approaches the 5,000 mark, it is going to be a very, very strong mark. Like, does 5,000 really mean anything in the grand scheme of things? Well, not really. It's really just a number. But humans care about these things. Humans care about whole numbers. For whatever reasons, whole numbers just make a whole lot more sense to humans compared to just some random number like 4,851. Humans care a lot more about whole numbers, and you can use this to your advantage. And what do I mean by this? So if we look at things like all-time highs, we can look at retracements. We can look at retracements down from, for example, the 4,900 mark. We can look at retracements down by 50%, like a 10% drop. So, for example, this is a 10% drop down to the 4,700 region. So, if the market drops straight away from tomorrow and start dropping straight away for 10%, it's going to reach around the 4,700 mark. And this is significant for humans because humans call this a correction, which means that this is a potential buying opportunity for you. So what we're looking at is opportunities. We are not saying, oh, look, I think the market is just going to go up, or I think the market is just going to go down. We are looking for opportunities. It is the opportunities that we are looking for. We are looking for opportunities around the 4,800 mark. We're looking for opportunities around the 4,700 mark. And the main thing is to capitalize on these opportunities and not saying, oh, well, I don't know whether the stock market is going to go up or whether it's going to go down. So now let's look at some of the factors that contribute to why I believe this year will be a great year for the stock market. Now, the first thing that I want to look at is the inflation rate. So for the inflation rate, I'm looking at the US market. So I'm looking at the US inflation rate. So from the beginning of January of 2023, you're looking at an inflation rate of 6.4%. I know it's a bit hard to see on the chart here, but this is 6.4. So from the beginning of the year in 2023, it has gone down significantly from 6.4%, 6%, 5%, 4.1% to a low of around 3% around the middle of the year of 2023. And since then, it kind of just bounced around the 3% region. So for the 3% region is where the inflation rate, this is in the US, of where the inflation rate has been hovering and currently is at around 3.4%. The inflation rate has been holding relatively steady over the past 6 months at least, which is a very, very good sign because inflation rate relates directly to how much people are actually purchasing other goods. So when inflation is lower, people are more likely to purchase other goods, which means that most companies can make more profit. The other factor that's directly related to this is the US Reserve Bank interest rate, which is the Fed interest rate. Now, over the pandemic period, the Reserve Bank has lowered interest rates to almost 0% to try stimulate the economy, to basically encourage people to take out loans for businesses, houses, and all that. And after all of the lockdown have ended, the US Fed entered into a rate increase cycle. So from the beginning of 2022, it's just gone on this big rate increase cycle in order to curtail the inflation rate, because inflation was going rampant around this area, and the main way to reduce inflation is to increase the interest rates. So over time, around end of 2023, where we can see from the previous chart that inflation was a little bit more under control, the Fed has stopped increasing the interest rate. So the interest rate currently was sitting at around 5.5%. A steady interest rate is an extremely good sign as a start. Now, what we want to look for is the first sign of decrease in the interest rate. So whenever there's a decrease in interest rate, there's a significantly more incentive for people or companies to take out loans for new houses, new investments, new businesses. So we're looking for signs that point to the decrease in interest rate. And when the market senses that sign, is probably going to take off again. And all signs have pointed to that the interest rate are looking to decrease again. Probably not straight away right now, but probably sooner than you would think. The third factor that we're going to look at kind of suggests that we're looking at a bounce back in terms of the economy is the GDP annual growth rate. The GDP annual growth rate basically is a number that roughly estimates the increase in production for the company. Overall, what we are looking for is an increase in the growth rate of the annual GDP. So from January of 2023, it's looking pretty low at 0.7%. And over the last year, it has gradually increased to 3.1%. So the main thing that you are interested is that it is on a constant increase. A constant increase is a good sign of a healthy economy. However, there's some potential trouble on the horizon. So there are two main factors that could really derail the bull market that we're kind of experiencing at the moment. So the first thing is we're experiencing a significant amount of tech layoffs. So from this article, which shows all the major tech layoffs in 2024 so far. So Unity has laid off 1.8 thousand employees, which is around 25% of the company, which is a huge amount. Riot Games, probably the biggest gaming company in the whole world, has laid off 530 employees, which accounts to around 11% of their employee base. Twitch has laid off 500 plus employees. So a lot of these major tech companies have laid off a whole bunch of employees, and it has only been in January. News also came out that Microsoft has laid off 1,900 Activision, Blizzard, and Xbox employees after the acquisition of Activision, Blizzard by Microsoft. Now, this may be really bad news for the employees, obviously, because it's always bad news that, people lose their jobs. However, when these companies do lay off employees, for the short term at least, they tend to get a boost in profits because they're laying off a whole bunch of employees and they're not really spending as much on employee salaries. So it usually would come off as a little bit better in terms of their bottom line. So again, in the short term, this is the short term, the company balance line will look a lot better than it did before, which would give the illusion that it has boosted its earnings. The main bright side of this is in terms of the market itself. A lot of times companies will end up spending this extra cash that they get to acquire or buy back some of their own stocks in order to boost their share prices. Again, this is not good for the employees of the company, and it may have some long-term problems further down the road. But usually in the short term, it kind of boosts the company earnings. Now I'm going to talk about one of the main things that may affect the stock market completely, which is the US election. And there's an article saying how the presidential election affects the stock market. Now, what the stock market does not like is uncertainty. And a lot of times, presidential election brings about uncertainty. So depending on what happens later on in the year, so the presidential election is obviously later on in the year. It depends on what happens in the meantime and leading up to it, it can significantly affect the stock market. And at this stage, it's relatively unpredictable as to what exactly is going to happen. However, we can look at some historical performances of the stock market of when or what happens when there is a presidential election. So this short article shows what the S&P 500 index total return during the presidential election years. So the first thing that's quite interesting is that when a Republican was elected, the average return for the year is around 15.3%. as opposed to when a Democrat was elected, the average return is around 7.6% for the year. And on average, all of the election year itself has a return of 11.28%. So when you think about it, overall, on average, election years are actually great years for the stock market. The average return of all the election years are 11.3%. So if you put in a bunch of money, like on the very first of January of an election year, more often than not, you'll end up coming out further ahead. So there's been 23 elections since the S&P 500 index began, and 19 of the 23 years, which is 83%, provided positive performance. So if you are a gambling person, if you don't know anything about the stock market and you just put in money in 83%, you'll end up better off if you just put money in to the stock market on the election year. Again, obviously past results does not indicate future success, and obviously every election is slightly different, but as a whole, election years are generally positive for the stock market itself. Now, what may kill the bull market and the gains are the uncertainties. The main thing is, like I said before, we're not trying to exactly predict what exactly is going to happen. We're looking for opportunities, and this year has tremendous opportunities for the stock market. If you're new to the stock market and looking to purchase stocks for the stock market, plenty of reviews here, and also have rewards associated to signing up with the different brokers. Make sure to check them out